Welcome to the second video. Make sure that you follow this sequence, and the last video, if you watch it, that's 01 and this is 02. And this is a series of videos that breaks down the applied financial accounting. What we are going to cover in this video is financial accounting. We will explain what financial accounting is, business structure, accounting cycle, and accounting equation. Though the purpose of this course is applied, but sometimes we cannot avoid the definitions and the concepts without walking through the application of these definitions and concepts and or principles. You may make a pause and look at the disclaimer. Now, what's financial accounting? Financial accounting is a branch of accounting. So I don't want to overcomplicate this. So accounting is not just one accounting. There are so many other branches, but this is what we are talking about is financial accounting. And financial accounting is a branch of financial accounting. I'm sorry, this is a branch of accounting. The focus is preparation, analysis, and presentation of financial information. So whatever is transacted, either it's expense or its revenues. So what we're going to do is that we prepare it, we analyze it, and we present it. Who do we do that for? So our stakeholders are investors, creditors, regulators, and general public. Though this is not a legal course, but since we are doing financial accounting, it's important to have some basic knowledge of business structure. So if we start with the first one, sole proprietorship, it's a business owned by one person, and the owner is liable for all business debts. Of course, he also benefits from the profits. The partnership, it's another model, and it's owned by two or more individuals. And again, the shares and losses are shared, and there are different models of partnership. They could be general partnership, limited liability partnership, depending on level of the liability protection desired. The next one is LLC or limited liability company. It's actually a hybrid business structure that combines the flexibility and tax benefits of a partnership with limited liability protection of a corporation. And the next business model is a corporation. It's actually a legal entity. It's considered legal entity, and it's separate from the owners. So if some people own it contrary to the first one and second one, so the corporation, they are separate from the owners, which are considered shareholders, and the company can own assets, enter contracts, can sue people or can be sued, and corporations provide limited liability protections to its stakeholders. So that means if the corporation does something wrong and the owners cannot be kept liable. The next model is S corporation. That means a small corporation. And it's a type of corporation that elects to pass corporate income losses, deductions, and credits through stakeholders for federal tax purposes. And the good thing about S corporation is that it's avoiding double taxation. So normally corporations are big corporations are double tax, and S corporations are single tax. And the next one is nonprofit, and the last one is cooperative. So there are advantages and disadvantages between these types of business structure. As I said, this is not a legal class, and as I mentioned, since we are talking about accounting, it's good to know these stuff. The next we are going to go through accounting cycle. as I mentioned, before we go into how we apply them, we have to know them and just to have an overview. And then when we apply them and we walk through everything in details. So the first thing is that we identify transaction. By this I mean that we analyze the transaction. It can be sales, a shop can sell, and this is purchases or expenses, or we are investing something, or we are borrowing, or anything. So the first thing is identifying transactions. The second thing is that we record these transactions, and it's recorded in a double entry bookkeeping principles. The next one is posting to ledger. It's also called T account. So basically, there will be general ledger and there will be different accounts for each asset, liability, equity, revenue, and expenses. And the next accounting cycle is called preparing trial balance. So whatever we started from identifying transactions to recording to posting to ledger, here now we are making a trial balance to figure out if we made some mistakes. Well, there are some limitations to what we can really do with trial balance, but this is not when we actually focus on what trial balance can do and cannot do. And the next step is adjusting entries. So this is a step when there might be, we are at the end of the month, and then there might be some um, revenues or expenses, and this is the time we make adjustment to that, to our entries, to reflect what, based on the revenue recognition principles originated from GAAP. And the financial accounting continues. We are then, once we finish adjusting entries, we enter preparing financial statements. So by financial statements, we will prepare like balance sheet, income statements, and statements of cash flows and statements of retained earnings. And the next step is that analyzing financial statements. So if basically this financial statement is healthy, is the business is making money or not, or um, making losses, or, and then because these information are important to be analyzed for big business decisions. And then we close entries. After closing, we will do a post-closing trial balance, and the last one is that reporting and analysis. Of course, in the next videos, in the next coming videos, we will walk through everything in details. So the next concept, what we are talking is about, which is actually kind of the starting point before we start applied financial accounting, is accounting equation. So what is accounting equation? It's a fundamental principle in accounting that represents relationship between a company's assets, liabilities, and equity. I'm sure you might be asking what asset, liabilities, and equities are. I have a definition for all these in the next slide. Bear with me. So what the takeaway from this slide should be is that if asset equals 5, liabilities plus equity must also be 5. Otherwise, there are some discrepancies, what I mentioned earlier, which we have to go in accounting cycle and then try to find those problems. And in fact, this is the foundations for double entry bookkeeping. You probably might have heard about double entry bookkeeping, and this is what it is. That means assets equals liabilities from plus equity. And this is a standard method to record financial transactions for all types of businesses. Here, as I mentioned, I will explain what asset is. So think of assets as things your business owns that have value. So what are those? These are some of the examples. Cash, whatever you have as a cash is considered asset. Inventory, products that you sell, equipment like computers, machinery, buildings. So they are all considered assets. Here is an example. For example, you're having a pizza shop and pizza shop has pizza oven. So the value for the pizza oven is $10,000. And this company also has cash in bank $5,000. It also has supplies worth $15,000. So if we say what is the total assets of this company, so $10,000 plus 5,000 plus 15,000 equals 30,000. In the next slide, we will be talking about liabilities. What are liabilities? Liabilities are debts or obligations that your business owes to others. So what is that? Let's give some examples, like money borrowed, payments due to suppliers for goods or services. You probably made some purchases for your business and then you have not paid your suppliers. Those are liabilities. Bills you still need to pay, for example, your electricity bill or any kind of bills related to the business. Let me give you an example. For example, you borrow some money from bank, $8,000. So your total liabilities are $8,000. And the last one is equity. So equity is the ownership interest in your business. So that's basically the portion of the business that belongs to you or your stakeholders or shareholders, we also call them. Let's give an example in the next slide. So here, actually example is in this slide. I'm sorry. Let's say you put your money into your business or you put your money as an investment and you make profits, so that increases your equity. Or if your business loses money or you withdraw money, so that decreases your equity. So your equity represents the value that belongs to the owner of the business. So in this example, the owner's equity is $22,000. So in the last 3 slides, we got assets, we got liabilities, and we got equity. And then now, how we put all these 3 pieces together that forms accounting equation. So accounting equation, as I mentioned, is assets equals liabilities plus equity. So there we had, and then we the pieces for assets, or what actually falls under assets, like cash 5,000, supplies 15,000, equipment 10,000. So that equals 30,000. Equals liabilities. You remember we borrowed money, $8,000 from bank. Here is the accounts payable. It's called accounts payable. That means this is a payment that we have to make. Of course, in the upcoming videos, they all will be broken down with more explanation, with more examples. But this is the starting point to give an idea of what they are. The last piece is the owner's equity, so $22,000. So as we see, this part of the equation, which is asset, equals liabilities plus equity. In the coming slide, in the coming video, we will be our focus will be on accounting equation with a case study. So get ready for that. See you in the next video. Thank you.